Good morning, Munson here with the Money and Finance for Expats podcast. Let's bring on those men of the moment, Paul Correa in Gibraltar and Matt Penfold at the offices at Fiduciary Wealth as well. How are you, gentlemen, this morning?
Morning, Carl. Very good, thank you. And you?
Yeah, excited to talk to you this week. Wealth management, turbulent times. Those turbulent times aren't showing any sign of letting up, are they? And we will begin this week with a little bit of macroeconomic analysis, I think, from you, Paul.
Well, the subject matter hasn't changed from the last podcast we did last Wednesday. I think we're almost ignoring all the incoming data and focusing exclusively on Federal Reserve interest rate decisions and the impact it's having on the banking sector.
Yeah.
Because I think that could be the elephant in the room that can push us into a global recession if we're not very careful. And I think the last time we spoke, the Federal Reserve were meeting on Wednesday to determine interest rate policy. I think the market was betting for a 25 basis point hike. That's exactly what they did, 25 basis points. I think you asked me a question, Carl, what advice would you give Jerome Powell if you were a board member of the Federal Open Market Committee? And I said that my advice would be not to increase rates. And I stand by that statement. It's interesting. It's interesting they've increased rates. The bond market, we have an inverted yield curve. So it means the yield on short-dated bonds to US Treasuries are higher than the long end, the 30-year Treasuries. And we covered that in the last episode. Basically, the market is pricing in a recession. It doesn't happen all the time, but however, it's also pricing in 3 rate cuts in the latter part of 2023. So, I mean, you can bet against the market, but the market is a collective of, or how can I say, it takes decisions from the best decision makers. When people in the market are there, they analyze data, and then they collectively price different instruments based on their best judgment, right? And the market seems to be shouting that rate cuts will happen sometime in 2023, and they're pricing in 75 basis points. That can change, right? I mean, 2 weeks from now, the outlook can change very easily, and they could be pricing in rate hikes. But it looks like we've got to the end of a rate increase cycle, and the logical thing is to pause now or to start reducing rates very quickly if the banking system in the US gets more strained. I want to share 2 graphs which are, I think, very interesting. The first one, if you put the other one first, that would be fantastic. Yeah. This one essentially is the US deposits which are being held with commercial banks. And I think we talked about commercial banks in the US holding their own capital in US treasuries so that they can get a yield on their capital. And the fact that interest rates going higher means the price of those US treasuries come down. That reduces the amount of reserve or the amount of capital the commercial banks have, which means that if they have less capital, they are more constrained in terms of their ability to lend, which is what we're seeing, right? They have less capital, they have less ability to lend money. Less lending means the economy starts contracting, and it's having a disinflationary effect on the US economy. But this graph is particularly interesting because it shows that deposits at US commercial banks have collapsed since April of 2022.
Hmm.
So when the Federal Reserve started raising rates was a couple of months before, but after the first rate increase, the path and the trend is very clear. Commercial banks have been losing deposits, I guess, because the money has flowed into U.S. Treasuries. That is my best guess. I don't know, but it's the graph is clear, and you if you go back to recessions and you look at the horizontal axis, which says zero, every time it falls below a certain level, and it has in this instance a massive drop in commercial deposits deposits in at commercial banks, then it triggers a recession. And yeah, in the last year, it's been phenomenal. I think we go back to 1974, and we've never seen such a steep and fast decline in US deposits at commercial banks. So that is clearly an indicator that the banking system is strained. And if you consider this fact together with these commercial banks holding US treasuries, which are losing value because of higher interest rates, the combination of l- commercial banks having less in capital because their investments are falling in value, and the fact that deposits at commercial banks are falling off the cliff at an alarming rate, you can imagine how strained the US banking system is and how fragile it is now. And it cannot sustain um, further rate increases. We know that the burden of debt is such that it's completely unsustainable. And the second graph I find also interesting. If we can display that, because I think last week I talked about um, quantitative tightening, which is the opposite effect of quantitative easing. We had quantitative easing throughout the COVID pandemic, which is the printing of money and creating more liquidity in the system to counteract the fact that um, um global economies had gone into lockdown and to avoid an almighty recession. Totally understandable. And then we mentioned that in September 2022, um, the Federal Reserve was reducing its balance sheet and essentially letting bonds mature and not replacing them to drain money from the system. Yeah,
Hmm.
and I think I mentioned that there was 4 trillion of money in the system pre-pandemic, rising to 9 trillion at its highest, and it has been being reduced at a rate of 95 billion a month. Well, what I didn't say, because I didn't have the graph in front of me, is that in the past few weeks they've started through the back door doing a bit of quantitative easing again. So they've been injecting about 400 million of liquidity into the system, and this is why you see a very, I won't say steep, a gradual decline in the amount of money in the system, right until about a week or two ago, and then it jumps up again. I mean, basically, the Federal Reserve has pumped 400 million of liquidity into the system to avoid systemic risk within the US banking system. So, interesting curve how they have started injecting money back into the system. So, I think based on the weight of evidence of that graph, it seems that they are starting to inject liquidity into the system again, because otherwise another US bank will fail,
Yeah.
and the risk is systemic risk and spreading across the entire US banking system and having an effect globally. So there
Yes.
must be concerns there. They haven't gone out in public and said we're reversing our quantitative tightening and blah blah blah, but they've actually pumped $400 million into the system again, because they know the system is stretched, the liquidity is becoming an issue, the banking system is under a lot of duress and stress. It can collapse on the weight of debt and rising interest rates. And if they don't act, the system will crack. And the evidence is that graph that they've injected 400 million of cash into the system. So the system is not as robust and secure as Joe Biden wants to tell us, and it is not so robust and strong as Jerome Powell seems to insist. The banking system is under a lot of pressure.
Well, that's what I want to ask you about, and I'm sure other people do as well. Do you mind me jumping in at this point?
No.
Because there is talk, and how you're couching, framing this is, we're on the verge of a global recession. Now, that's in people's personal experience. That's very subjective and very personal, isn't it? Some people will be feeling that already, and there is a cognitive dissonance. Is that the right phrase? Where you turn on the TV and you may have any number of financial commentators in the mainstream media saying this very thing, that we're on the verge of a global recession, and the financial grown-ups are doing their best, and the politicians to not let this happen, and they're all working hard on your behalf to stop that. They seem to have one foot on the accelerator, and if you look at that, the accelerator as being the quantitative easing, foot to the floor, and then the other foot is on the brake. There are no feet off the pedals at the moment, are there? There's the brake. They're balancing the brake and the accelerator. And all their strength as drivers is going into that, is how it would appear. And to mix metaphors,
yeah.
Sorry, go on.
I think you use a very nice phrase, cognitive dissonance, which is effectively, that your belief system is not aligned to what's happening, right?
Exactly.
There's a misalignment.
When you go to the supermarket, or you fill up your car with fuel, or you go on holiday in France, the world it seems a little bit different to how it's being presented as a manipulatable economic picture by the central banks and the politicians together. Our world is different to their world, isn't it?
Completely. I think we live in parallel worlds.
Yeah.
And you're right. I mean, the picture is painted differently, and the Federal Reserve in particular think they can engineer a soft landing. I don't know. No one really knows what's going to happen. But one thing has always been clear throughout the last 3 years: the global economy cannot sustain this level of debt. And you either endure pain and start repaying the debt, or you let the system break and you go into recession.
Yeah.
Or the third option, which is what I think they're trying to do, the central banks will pretend that they want to bring inflation down, but it's quite convenient to have high inflation because it devalues the debt in real terms,
Yeah.
and it's a tax on the consumer. It's a stealth tax on the consumer. So there's three options on the table. I don't know what's going to happen, but you're right. I mean, they try and paint this picture of control, but they're not in control of anything. And I don't know whether we're going into recession or not. I can only present the facts based on graphs and try and interpret them and what it could mean. And look, the first graph showed that that US deposits at commercial banks have fallen off the cliff.
Yeah.
I mean, so liquidity is very strained, which is no surprise. And then the second graph shows that to make up for that fact, that there's liquidity constraints within the banks, and the banks are being and the losses on their investments, on their capital, so their capital is being reduced, means that they have less ability to lend. So they're trying to inject liquidity into the system to prevent the banking system from collapsing. The evidence is there. It's not, how can I say, this is not a subjective analysis. It's pure hard facts. So, I mean, are we going into recession? I don't know. I really don't know. I know that the banking system is very strained. And I know that rising interest rates, in my opinion, personally, and this is just one lone voice, I think raising rates is a mistake. And the bond market is pricing 3 rate cuts in the US by the end of the year. Why are you going to raise rates and be so stubborn with with the policy? You have to be flexible on the detail. And you see a banking system which is on the verge of collapse, and inflation is starting to come down very gradually, but there's evidence. If if the banking system cannot lend, it means the economy will slow down anyway.
Yeah.
So the housing market, I think the data came out this morning, I think it's for the seventh consecutive month, US house prices have come down. Why are you going to do another 25 basis point rate cut when you're going to put more strain on the system? It's just so illogical.
Yes.
And look, I'm not an economist by trade. I've studied economics for 10 years,
Yeah.
but it doesn't make sense to me. I mean, the evidence is there. I mean, what are they trying to paint? A picture of economic stability and a very strong banking sector? That's not what the graph shows.
I think they are, and I think the business you are in is wealth management. Clearly, you both are. So the question remains, in the scenarios that you describe and your inklings and suspicions, what to do. So we'll address that in just a moment, and we'll take your questions as well if you're watching. And this is a puzzle to you as well, that the reality of your life doesn't really is not in sync, is not synchronizing with the picture being presented to you via the mainstream media in how the central banks and the governments are managing this situation. We'll look at the possible scenarios and what to do about that, because Paul Correa and Matt Penfold here are in the business of wealth management, and will offer some solutions. But another analogy comes to mind. Sorry to mix up so many metaphors, but it helps me understand this, and I wonder if you agree with this one. We're all like employees at Enron at the moment, are we not? You go into work working for what seems like a very stable company. Behind the scenes in the boardroom, other things are going on. The creative accountancy, shredding of documents and that sort of thing. On the face of it, they went right to the wire, didn't they? That everything's fine here. In fact, my mother worked there, and they were keeping up this front, and then it was a sudden and terrible shock to everybody, wasn't it? Not least the employees, of course, who lost all their jobs and their stock in the company. But to the outside world as well, how does a thriving energy company fold like that? Are we not like Enron employees en masse here? Us people who are subject to the choices of governments and central banks, assuming that all is well. Having that rosy picture painted for us, and that everything's under control, you needn't worry, everybody. But actually, behind the scenes, this terrible struggle is going on.
No, I don't know what to say. I think that they're painting there's a false sense of security because
Yeah,
stock markets are holding their value. And everyone thinks because they're holding their value and COVID pandemic is now behind us, everything is fine. And that we can now turn the page and move forward. But that's not reality. And the problem is that stock markets can turn around very, very quickly, especially if they smell and sense that there's a looming recession. And for now, markets are holding the value. But it is very worrying to see deposits at commercial US commercial banks dropping like a stone. It's very worrying to see the Federal Reserve pumping money into the system quite sneakily when they're talking about quantitative tightening, so reversing their quantitative easing policy. It's very concerning to see, and no, and then the Federal Reserve completely in their own little world, raising rates, pretending that that's not going to tip the US economy over and spill over to the global economy. So it is very worrying. And it's more worrying for people who invested in traditional assets in stock markets, thinking they'll perform extremely well and it's insulated from the downturn in the global economy. It's not. We
yeah,
have to be careful. And
yes,
and things turn so quickly. I've seen it in the past. Sentiment can change overnight,
yeah,
and markets will drop 10%, and the next day they drop 2, and the next day they drop 3, and before you know it, they've dropped 30%.
yeah.
And this is what we need to guard against. And there's no magic bullet. Carl. There's no magic bullet. There never has been. There never will be. But what we need to do is to think rather than short term, long term, and see what assets could hold a bit better in a global recession or in a downturn, and we could and that could potentially um, produce actually good returns further down the line. We have to move from this short termism, which is what's taken us where we are now, greed
Yeah,
and short termism, and think long term again, because all the rest is just, as you say, manipulation. It's not
yeah.
reality.
Can we talk more specifically about some of those tools then and techniques for the longer term
Yeah.
to give people some ideas here? Your specialism, of course, is working with Brits who are relocating to the Iberian Peninsula and Gibraltar, of course. And much of what you say, I think, can be extrapolated for a global mindset and market. So, thinking longer term, what are the tactics and techniques that people might consider?
Well, I mean, this is going to sound strange for a wealth management firm, but having a bit of cash and firepower or powder. How do you say the expression? You have to correct me there. A bit of firepower on the side, yeah.
Yeah.
Having that cash that you can deploy where the markets go down is sensible.
Okay.
It's sensible. I know that many clients get very nervous, and my investments are losing money because it's being eroded by inflation, and they're very impatient. But this is not a game for people who are impatient. This is a game for people who are long-term investors and are smart and intelligent and understand that at times having a bit of cash on the side is an opportunity that can be exploited. And then we keep saying the same thing. I mean, maybe in the last 3 years we still haven't seen it happening, but the price of gold and silver will be revalued. It's a matter of time. Central banks are buying more and more and more of their reserves in gold.
Yeah.
It is a fact. I could bring a graph and it will show it conclusively, and there would be no doubt. So we need to be with them. You need to flow. You need to chase the money flow. Where's the money flowing into? What is undervalued? And you have to take that contrarian view. But you have to be very patient at the same time. But I think that people who are invested in traditional markets, with their bonds and in your typical US equities and European equities and UK equities and so on. Um, it's a dangerous game because, again, hopefully, they will reverse their policies, start reducing rates, and possibly pumping liquidity against the system. The same very problem, kicking the can down the road and creating a problem for the next generation. And if that happens, of course, the party continues and you
Yes.
keep dancing, yeah, to the
Yeah.
tune. But there's also an equal there's a risk that there's no party and the lights are off, and then you have all your investments in traditional markets, and you can't get out. You can't get out because the market will flip very quickly, like we saw on the 27th of October 1987, that Black Monday in the UK. I don't know how much it dropped, but it dropped significantly in one single day. It can happen.
Yeah. Yep, so, that can and if the cycles of history are to be observed, may well happen. It's anyone's guess, as we often say here, as to when, but that's something that we certainly need to be aware of. Matt, we've not heard much from you today. On the front line of wealth management, what are people's concerns at the moment? You're talking to people all day long about managing their wealth. What are the common concerns right now among people?
I think it does vary, Carl, but Paul said an interesting thing because I was thinking it exactly the same. And holding cash at the moment is something people are really kind of reluctant to do, especially, within their kind of wealth management. And from our point of view, and a couple of people I was speaking to recently have tried to kind of resist that.
Yeah,
But it's in such uncertain times, and there's so many kind of mixed messages, from the Fed and the central government. I'm not quite sure they know what the end game is. So how are we meant to kind of plan towards that? But holding cash works in two ways. It protects from downside, but also there's that opportunity. If markets do roll over and then you're entering at a lower point as well. So we're talking about that with existing clients, with new clients as well. Let's not, everything into the market. A drip feed effect in these sort of kind of circumstances works out well as well. That's a tool to kind of reduce down the risk in the short term as well. But I think from our point of view, sometimes I feel like we're wealth managers, but an element of our role is counselors as well.
Yeah.
And often you can have these conversations, and it's a big part of our job, because we want our clients to have peace of mind, and we're all logging on to the internet, reading papers, and there's so much kind of negativity around at the moment for obvious reasons.
Yes.
And it's our job to talk them through it, and try to encourage them, and make sure that they don't panic in this situation, and explain to them the sort of assets that we're holding, which Paul has gone through, and it's a difficult time, because you want to have a portfolio that's resistant to a possible recession. But then if they kick the can down the road and that doesn't happen, people obviously want to grow the value of their portfolio as well. So we spend an incredible amount of time in that, and it's really this kind of two-phased attack, and that's the message that we want to communicate, well, to our clients, and of course the viewers to the podcast as well.
Very good. Okay. And if you want to talk to Fiduciary Wealth Management, go to all the W's, fiduciarywealth.gi. Recent meeting then of the BRICS countries, a bit of a summit. China and Russia getting quite friendly, it would seem. How worried do people need to be who are still trading, as it were, metaphorically, on the dollar being the safe currency? What did you make of that meeting last week?
But I think we've covered that in previous shows. I think it's very clear that both China and Russia want to de-dollarize, and they're already taking tentative steps to move away from the US dollar. The US dollar will lose its status as reserve currency of the world. We never know. You never know when, but they're already pricing. I think Russia is pricing oil in other currencies, yeah, to circumvent those trade embargoes. So there's a real drive now, looking at the BRIC countries and a few others, to including Iran, to develop their own digital currency and move away from the dollar. So and remember that the US dollar, was a reserve currency and everyone buys it, it funds, the US to a large extent, because people have to hold the dollars.
Yeah.
If they start dollarizing, that does pose a risk. It's not just that it loses its status, and that's a standalone event. It's the ramifications of moving into another currency.
Okay. And
It's
are
it's the
there
same way. I'll give you an example. A lot of the Japanese have traditionally held a lot of US debt
Yes.
in dollars, yeah. So they have effectively funded the US, because the
Yeah.
US, borrows and issues treasuries to fund the economy, right? And when you don't have enough domestic buyers, then you have to look for external buyers. And the Japanese have been buyers of US treasuries for a long time. If Japan decided, I'm not saying they will, but if Japan decided to repatriate their investments to buy yen and strengthen the yen, you can imagine the
Yeah.
implications for US treasuries, right? So no, I think it's not just a standalone event. Oh, it's losing its reserve currency status, and okay, fine. It has other consequences that one has to consider, but it's
Mhm.
moving in that direction. The question is, how it might take a long time, might take less time, but clearly before it was just noise, but now you could see that there's a real drive and determination to develop their own currency.
And are there opportunities there, or is it too risky and too early to be thinking like that?
I don't know. I haven't really thought about it.
Yeah.
Don't hold as much US dollars unless you're a US dollar, unless US dollar is your base currency. That's the obvious thing to say, right?
Yes.
Yeah, I
Uh,
think opportunity is yeah a very risky move. We say many times, Carl, but we're not traders, and maybe there's some very smart currency traders out there who will take advantage. But the problem again is the time frame. We know the intention of these countries and their motivation behind it, but these things don't kind of happen overnight. So we're boring, straight guys. You've got your portfolio, as much as possible, keep that within your base currency. So, a lot of the people here, if you live in Portugal, Spain, your portfolio, your investments, as much as possible, should be in euros. That's your base currency. And then you're eliminating any currency risk. If you're living in Portugal, you've got a USD portfolio. Then, if there were significant changes, your investments could be doing great. But if they're, decimated by a change in the currency. So I think that's a key message, really. Remove that risk. Don't try
Okay.
and take
Fair enough.
advantage of it.
All right. Yes, I did try to draw you out onto the future of the impact there. I suppose part of the concern you have for global recession, it is based in the old empires, isn't it, of the British and American banking systems, and it's an interesting time we find ourselves in this part of human history. So we'll keep talking about that. We're here every Wednesday at 11 o'clock to answer these questions and to address these issues. Your final thoughts today, then, gentlemen, as we look forward to being back with everybody next week. To you first, Matt.
It's a difficult one today, Carl, really. And what I would say is I sometimes think we come as very negative across this program, but I guess it's a reality of the situation at the moment. But it's just reality, and I think we'll repeat. You have to be patient. You have to keep a long-term view. It is very key in these sort of markets.
Okay, thank you very much, Paul.
the market can turn around very, very quickly if there's a credit crunch, and the banking system can push us into a deep recession. And the evidence is that the Federal Reserve recognizes this and is pumping liquidity into the system. Whether it pumps enough to ensure there's no systemic risk, who knows?
And by
But
credit crunch, you mean the people looking for credit from the banks and the banks being stingy on that basis.
there's no liquidity. The
Yeah,
banks are struggling to, they've invested their capital in short-term securities,
yeah,
which have been decimated in value because of rising interest rates. So
yeah,
that means that their capital has been eroded. The bank's capital in the balance sheet has been eroded because the investments have lost value.
yeah.
And if they have less capital, they have less ability to lend.
Okay.
And then on top of that, because they have got less ability to lend and people are losing faith in the banking system, they're
Yes.
removing their commercial deposits from US banks and investing it somewhere else.
Yeah.
And that is another factor to consider. So, from past experience, liquidity is everything in financial markets, and a credit crunch can turn the stock market around very, very quickly. I'm not saying it will. I want to make it clear. It can. It
Okay. Well,
can.
one more thing in the immortal words of
Yeah.
Colombo. One more thing. Are you happy with what's been done for Credit Suisse? We're here in Europe, of course, and that is perhaps our most contemporary and concerning issue. Are you happy with what's been said and what's been done for Credit Suisse?
What is a shotgun marriage? It really is. I mean, these are banking rivals. They hated each other, right?
Yes.
And and Credit Suisse, I think, and UBS, I think, has been pushed by whether it's the Swiss government or the Swiss central bank or the regulators, all of them putting pressure on UBS to acquire Credit Suisse because they want to salvage the bank, right? And it's really important for them because the Swiss economic model is based on, having a private banking um, sector which is really, really strong, attracting money and so on.
Mm.
And if Credit Suisse were to fail, then it really damages their financial sector. So it's a shotgun marriage. Credit Suisse was vulnerable. They can let it go like Lehman, or UBS can come in as a white knight and acquire Credit Suisse, you know, whilst at the same time eliminating one of its fiercest rivals. And that's what they've done. But look, they don't. I don't know whether they've done it willingly or not. But very often we saw it during the global financial crisis. Is that governments and central banks put pressure on banks to acquire failing banks to keep confidence in the system. But look, these are commercial entities, and you don't want to buy a failing bank if it's going to create a problem in your balance sheet, right? So you have to be careful.
Okay.
You can't just
Shotgun
be
marriage
swayed
is.
by the interest of the greater good and the nation, because they are a business. And would you buy another business that was in distress if you think that it could bring you the whole your
Probably
business
not.
down? Probably
Probably
not.
not. Good question for everybody. Bring those
Yeah.
questions next week. We're here 11 o'clock London and Lisbon time to answer questions around wealth management or here on the Money and Finance for Expats podcast in these turbulent times. We'll see you again next week. Thank you, gentlemen, so much. Bye for now.
Thank you.
Thank you all.
Bye-bye.
Bye-bye.